Good afternoon and good evening to our participants and to our distinguished panel that is assembled today to release the quarterly review of the economy that NCER does every quarter. This is, of course, for the first quarter of 2021. And we're very privileged to have this distinguished panel which has worked on this report, and we have a distinguished guest with us. Let me first introduce our guest, Usha Thorat. She hardly needs an introduction. Former Deputy Governor of the RBI, responsible for just about everything that I can think of: currency management, deposit insurance, credit guarantee, inspection, the premises department, rural planning, credit, urban bank. So she's really gone through the whole tour of duty at RBI, and we're delighted to have her. Of course, she's had a distinguished career after RBI, including at Kafral, a whole number of different institutions where she's been part of the governance of those institutions. It's a long career track, and we're just absolutely delighted that she's with us. Thank you for joining us, Ushaji. Let me introduce very quickly the authors of the report. Sudipto, Mundle, again, somebody who hardly needs an introduction, but who is distinguished fellow at NCER. He leads the team that has been working on this. Sudipto, of course, again, has a very long and distinguished career at the National Institute of Public Finance and Policy, member of the 14th Finance Commission, acting chairman also of the National Statistical Commission, a whole range of other committees of the Government of India, a long career at the Asian Development Bank, including chief economist at the India Resident Mission, and of course other assignments over his long and distinguished career. We are delighted that he's with us, and of course heading the work at NCER on our macro and reviews of the economy. We're also delighted to have Professor N.R. Bhanumurthy. Bhanu and we go back a long ways, and this is really a partnership in that sense between him at NIPFP and our team at NCER. Bhanu also has worked extensively in a number of different areas and has been a macroeconomist also with UNSCAP in Bangkok, UNDP Regional Center for Asia Pacific at Colombo. He's had visiting fellowships at a number of Asian and European and North American universities, as well as at the World Bank and the ADB. And finally, last but not the least, the powerhouse behind this team, Dr. Bornali Bhandari, who has been doing this work for a number of years. Bornali has been at NCER as senior fellow with a background in international economics and macro. She's, of course, very involved in this work, but has also led our work on direct benefit transfers in Indian states and union territories. And she oversees not just the QRE, but also the Business Confidence Index and the work that goes into that. That's the lineup for today. We're absolutely delighted they are with us. This is a very special time, and this is a very special QRE. So we've actually called it QRE in coronavirus times. I don't need to give a long introduction. Our 105 participants now, I'm sure, are extremely aware of the dilemmas that any policymaker faces between lives and livelihoods, very simply put. We're now into our third lockdown period. We may be entering a fourth, though qualitatively different lockdown period. At the same time, the economy is ground to a halt. Millions of jobs have been lost. We've seen the pain and the misery that our migrant fellow citizens have been subjected to. It is a very difficult time, and I guess the worst time in India's independent history. So this QRE comes at a very important time in this journey of India, and we're looking forward very much to the assessments from our panel of experts, followed then by comments by Usha, who I know is going to focus a lot on financing the kind of deficit that we are looking at and financing the various recovery packages that we are looking at. let me not stand between you and this distinguished panel. Request Sudipto to kick off things. Sudipto?
Thank you, Shekhar. You know, they say that every challenge is also an opportunity, and I think this QRE webinar is really an example of that. We're all going through very difficult times, but normally we release our QRE, and this is for all our viewers, in a small, relatively small room with maybe 25, 30 people at the most, and here we are locked in our houses and our homes, but we are now reaching out to 100+ people through this webinar system, and maybe it is a lesson for us on permanently changing the way we do some things.
I should just add there that it's not just the 107 or the 112, 15 now, as it keeps increasing. But of course, this will be recorded and put on our YouTube channel as well. So it will be accessible to a much larger number.
And I am just introducing the presentation. But before I hand it over to Bornali, let me just say that though only 3 or 4 of us are going to be speaking today, there's a huge team behind this whole effort, and they are all actually listed in the list of team members. And especially, we would like to acknowledge, there you are, it's on our screens now. I do particularly want to thank Usha Thorat, who is really, one of our leading central bankers, and we needed very much her insights, and she is going to come in and comment on the whole challenge of financing this huge fiscal stimulus. Broadly, what we will do is I'm now going to hand over to Bornali, who's going to walk us through the what's been happening in the real sector and for prices and the trade and so on. After that, Bhanumurthy is going to present the simulations that we have run. Normally, we do forecasts for this kind of QRE, but in these challenging times, standard methods of forecasting are out of the question. So we've resorted to basically simulations on what is likely to happen if we assume A, B, C, D, and that is what Bhanumurthy is going to take us through. And after that, I will come back towards the end with some remarks on what can or should be done on the fiscal policy side and about how to handle issues, very challenging issues on the monetary policy and the financial sector. So with these couple of initial remarks, let me now hand it over to Bornali. Bornali?
Bornali, before you start, may I just inform our participants, indeed welcome them. Thank you for joining us. This really is our attempt to reach out to as large an audience that we can. And if you have questions, please use the Q&A box on your screen. Please send in your questions. We will try to take as many as possible towards the end of our presentation today. Bornali, please. Bornali, are you there? Hello? Hello? Bornali, you may want to turn off your video in case there's a bandwidth issue you're facing. And you may want to back out of your screen share. There you go. Hi, Bornali.
Yes.
Bornali, we can't really hear you. Hello?
Hello.
Yeah, we can hear you now.
Sorry, my electricity went off exactly at the time.
I see.
So without further ado, good evening. Good evening, everybody. And so what I'm going to go through is review the economy and set up for what we perceive as what based on our domain on consultation.
Brunali, are you sure your internet is working fine with the power outage that you just had? Maybe you need to make sure that because your bandwidth seems to have gone down quite dramatically in the last minute or so.
I was connected through my data immediately, so I think my Wi-Fi should be back in a few minutes, a few seconds.
Good, you're back. There you go.
Okay, good. Sorry about that. Yeah, sorry about that. So what we find is, again, welcome everybody and thank you for joining with us. So what we start with is the gross domestic product growth and what we find is that GDP has declined on a sustained basis even before coronavirus crisis hit us. So what we want to emphasize here is that the Indian economy was weak even before this current coronavirus pandemic struck in February. And GDP growth has, and we have based on our expectations, we revised that the GDP growth for 2019-20 is going to fall to 4.5%, unlike even what is predicted in the second advance estimates at 4.9%. What we find is that when we look at the agriculture sector, there has been a sharp decline in agricultural growth since Q4 17-18, and the agriculture growth in 19-20 is assumed to be 2.4%, and in 2021 we expect that growth rate is going to remain around that, virtually stagnant around that. Partly is what we expect is the monsoon. The southwest monsoon is predicted to be normal, so therefore we expect agricultural growth to be normal for the remaining year, but obviously there might be supply side disruptions. So we have adjusted it accordingly. We do find that in the end of March, especially the last week of March, we did find that horticultural production and dairy production were affected, but that those supply chain distortions, at least in dairy production, were corrected by mid-April. In industry growth, industrial growth has very sharply fallen. It has been falling since 15-16. And in 19-20, by fourth quarter of the last 1 week of the economy shutting down, we expect growth to have fallen even more sharply in March. There were some green shoots in January and February, but the coronavirus wiped out those green shoots. And in 2021, we expect 2021 first quarter, we expect that GDP growth, industrial growth to fall by almost 27%. This is based on subsectoral deep assessment of each sector, and based on that, we have formed our assessments. And each sector will have a different reaction to this coronavirus growth. When we look at the index of industrial production, essentially confirms this. The index of industrial production has fallen to negative 3.8%, and it has been primarily driven by manufacturing. So essentially what we see in these numbers are that IIP has fallen, now has been in negative territory for almost 3 quarters, for the 3 quarters. So, and the coronavirus has only deepened, in most likelihood it has only deepened this pandemic. When we go to services growth, what we find is, again, here, services was the first one to be affected because trade and tourism were the first sectors to be affected. We even have a small box on the tourism sector. What we find there again is that 2021, we expect that in the first quarter, we expect almost 16.3% decline in growth in the services sector. But there's a minor qualifier in the services sector. There are some subsectors like the communications, health, and public administration, which may actually benefit in a positive manner because of their increased association with the coronavirus. So in this, so all three industry and service sectors, which are the drivers of Indian economy, are both projected to be in negative territory. When we look at some more real-time data, especially revenue cargo traffic data, we find that both revenue earning goods traffic data and cargo traffic data have experienced a sharp decline in Q4. And basically this is that last week of March. We also find that aviation traffic, both passenger and cargo traffic were already in negative territory in January and February, and alternative data from other sources also show that aviation passenger traffic fell by 33%. So we actually also have another small box in our report on the logistics sector, which shows that reduction in efficiency of the logistics sector in turn has a negative impact on economic growth. So tourism arrivals also fell by 22% in Q4. That again, it was driven by the coronavirus. So almost all the major service sectors, leading indicators that we have from the service sector shows negative growth. Of course, and then this is from the supply side factors. When we look at the demand side factors, we have the GDP growth of private consumption expenditure, which had showed some marginal growth in the Q3. But when we look at IIP consumer durable and IIP consumer non-durable goods for more real-time data, we find that both of them have had negative growth for the Q3 now, and very sharp growth in the Q4, again, basically in March. So consumption, aggregate demand suffered a huge shock. And this is what we find in our NCR business expectation survey, where we find that firms adjusting their behavior because of the aggregate demand shock. Investor demand had fallen very sharply. It was in negative territory for both second and third quarters. And we expect that it's going to remain the same in the next first quarter at least. When we look at government expenditure, this is a more of a mixed outlook, where it was compressed and then it was reversed in the after Q1 of 1920. We expect that government expenditure compression would be again reversed in the Q4, which will be reversed again in the first as we go on to the new year to 2021 first quarter. So there will be so this will continue having a mixed outlook. So on the demand side, again, it's basically government expenditure which is driving our demand or having a major impact. On the external side, it's a very clear story. Exports and imports of goods and services, both of them have shown very negative declining growth since Q2 2018-19, and in the Q4, both of them turned to be negative. So it is again both, and the sharp fall is very visible in 1920 compared to 18-19, and quarterly trends are the same. I just do want to add to the external factor is that India is linked to the world, not just through exports of goods and services, but also through remittances. We expect a fall in remittances. There's an oil price shock, which will also be, has not been passed on fully to consumers. And we have seen an outflow of portfolio investment. Altogether has meant that the exchange rate has been depreciating. So in an interlinked world, on the other side, also we see India weakening. Overall, when we look at when we look at business sentiments, NCR has its own business confidence index, and we conducted the last survey in March. what we find there is that business confidence index declined very sharply in April 2020. It has been declining. There has been a linear trend, and it declined very sharply in April 2020. And it almost fell down to the, it was equivalent to the index number in the Asian financial crisis. So business sentiments have declined, and even more real-time data from Nikkei PMI, which is the more, which came out in April, again, it shows a very sharp fall in April 2020 about business and political sentiments. Lastly, what we find about inflation is that both, if you look at the quarterly data, what we find is that both inflation, consumer price index and wholesale price index have gone up. But this quarterly trends, especially the fourth quarter data, it hides that between January and March, if we look at the monthly data, that inflation had actually fallen. But the key story here is that even the recently published data, the April data on consumer food price index, which has been adjusted to leave out meat and fish, when we compute comparative food price inflation data, we find that actually inflation is going up. So inflation has actually gone up to 12% in April. And this is confirms what we see, what we are, when we had run our visualization model, and we find that inflation was supposed to be elevated around 6% in Q1 of 2021, but it but this was without the fiscal stimulus. When we're bringing in the fiscal stimulus, we expect that inflation to stay higher. So what we find is that inflation is going to go up. And this is what the simulations will also show in the later stages. On that note, I end here and I pass it on to Bhanumurthy for the, Professor Bhanumurthy for the simulation.
Bhanu?
Yeah. Yeah, thank you, Bornali. First of all, let me thank NCAER for including me part of this QRE. As Dr. Shah initially said, usually I used to come there as a discussant, but this time I'm happy to be partnering the NCAER in QRE. And I would also like to thank Sudipto Mundle sir for including me as part of this whole exercise. I'll straight away go to my PPT. Is that visible?
No,
not yet, but
yeah, maybe
it will take a second or two. Yes, it's visible now.
Now it's come, yeah.
If you can just turn on the slideshow so that we can see the full slide.
Yeah.
Thank you.
Yeah, so let me start from where Bornali ended. Now, if you look at, based on the sectoral experts' input that we have received from NCAER and as well as NIPFP, overall, we are expecting a decline in the quarterly GDP numbers for the first quarter of 2021 by 25.7%. I think that is the number that we are getting based on all the sectors. Like, for example, Bornali could not explain fully, but within the agriculture, we have differentiated agriculture, allied activities, as well as other crops and vegetables. So we have assessed all this at a commodity, very highly disaggregated way. So I think these numbers that's coming out is, in our view, is representative of what is happening right now. And if you look at the sector level.
If I could just clarify here, just for our participants,
Yes.
unlike usual QRE where we use our macro model to forecast growth,
Yes.
given the absolutely unprecedented economic situation we are in, what the QRE team has done is asked the sector experts in agriculture, industries, services, external sector to look at a much more disaggregated level and make assessments. And these are judgments, we have to say. This is not a comprehensive macroeconometric or a kind of forecasting model or a nowcasting model. This is really deep sort of assessments of what is likely to happen. And then we've simply aggregated these across these sectors. I just want to make that very clear to everybody. And particularly when I know that, people will take these as headline news, I want them to be very clear that this is a summation of all the assessments that we have done.
Yes. Yeah, I think that's a very important clarification. Thank you, Dr. Shah, for this. If you look at for the Q1, the agriculture, we're expecting a 0 growth. And for the industry, the assumption is minus 54.2%, and for the services, minus 16.3%. Now, more than that, I also would like to highlight, if you look at the Q4 of last financial year, where the expectation was that, the GDP growth would be something like 5.5 to 6%. Now, that has actually come down to 3% because of, we have already seen the slowdown was already there. And as Bornali pointed out, whatever the green shoots were actually gone off because of the impact of COVID setting in the month of March. So I think that is the starting point for us. The slowdown started, the impact of the COVID actually started from the Q4 of last financial year. Now, if you look at our own assumptions regarding Q2 and Q3, clearly we are not expecting a V-shaped recovery that many people are expecting. We are expecting a very slow recovery process. And because of the low base in the last Q4 last financial year, we are expecting a positive growth. We are assuming a positive growth in the Q4 of the current financial year. If you look at, we are assuming that it will grow by 0.5%. So overall, for the whole year, the assumption is that we are going to see a loss of almost 1/8 of the GDP, that is minus 12.5% GDP growth. And I also want to caution here that all these assumptions are based on a major assumption that there is no policy intervention, and that is our base case. Okay. So although we know there are a lot of policy interventions happening both on the monetary policy side and also on the fiscal policy side, we have been seeing for the past 3-4 days. In any case, what we are trying to do in this exercise is that what could be the impact of many of the measures both RBI as well as the Finance Ministry has taken till now. I think that is what more interesting. And as Dr. Mundle pointed out, this is not a forecasting exercise. This is more of a simulation exercise. And this is exactly where we need to assess what would be the impact of a proposed 20 trillion stimulus that the Finance Ministry is proposing to come up. I think that's what we are planning to do in this. So we try to do some kind of alternative simulations, and at the same time we want to understand what would be its impact on GDP growth and also on other important macro variables like inflation, current account deficit, as well as the overall fiscal deficit.
So while you're changing slides again, Bhanu, I think it's really important to convey to our participants that this is really the slide that you just had is really without bringing into play the various fiscal and monetary policy actions that have been taken starting from March 26th. And now in the last 2 days, we have seen a slew of new things coming up. So this is really as if the government had done nothing, more or less.
Yes, as if government as well as the central bank has done nothing, I think.
Sorry, I included the central bank. Usha, forgive me for including the central bank in the government.
No, Shekhar, I think right now the central bank is the major player, so we cannot.
Right.
Yeah. So what we do is that we use a macro policy simulation model that we have been using at NIPFP, where initially it was Dr. Mundle who initiated this whole project, and we have been working on this for quite some time, for over 10 years. So it's a very simple model where we have, it's more of a demand side driven model where, as I said, it's basically looking at understanding the macro fiscal relationships. And because of this, we have used this model for 3 finance commissions, 13th, 14th and 15th finance commission. The details are already there in the report. I'm sure the QRU report is already on. And so the details and the references are already there. I just wanted to highlight that we have a very standard 4 major blocks in this model, where it is income, fiscal, monetary, as well as the external, which is a very standard way of looking at it. And this model has been used for various policy questions that has come up from time to time. We have also used this model to understand oil price shocks and its impact on the overall fiscal inflation and other things. And we also use this model for estimating for the first time what is called fiscal multipliers for this country. I think so this is, in that sense, the model is very flexible, and it can easily change to address some of the policy questions that have been raised time and again. The current version that we have used this for working out a macro fiscal relationships for the 15th Finance Commission, and the report is already there on the Finance Commission website. Now, again, as Dr. Shah pointed out, usually the models are used for forecasting as well as simulations from something like a top-down kind of approach. Now, here what we are going to do is that we are going to impose that our assumption of minus 12.5% growth on the macro model, and see how, what kind of conditions that we need to derive in order to come to a GDP growth of minus 12.5%. Now here, I want to make it very clear, on the demand side, in our model, the exports are mostly driven by the external demand as well as tariffs. So in that sense, the fiscal, any fiscal stimulus or anything that government of India does doesn't have much impact on the exports, while imports is largely driven by the domestic demand. So any decline in the domestic demand actually has its impact on imports. So to derive this real GDP growth, basically we work on containing the government expenditure, both capital and revenue expenditure, and then we derive those conditions for our simulations. In addition to this, we have tried to work out some 4 possible scenarios. I'll come to that in a little while, especially to understand the recent stimulus measure the government of India brought in. So there are 4 scenarios that we are planning to do it. Now, if you know that when there is a compression in the GDP growth, we also expect that there is going to be compression in the revenues of the government. So because of the compression in GDP growth by 12.5%, our own estimates say that the government revenues also would have declined by something like 7 lakh crore without expecting any revenues from the disinvestment. So if you add disinvestment as well as tax revenues, you should be expecting to an extent of 9 lakh crore reduction in the overall revenues, and that would have actually implications on the expenditures, because in our model, expenditures are a function of the revenues plus the fiscal additional fiscal policy measure that is going to come up. So in the base case, we have seen a drastic reduction in the government expenditure because of the decline in the government revenues. But I'm sure all of us understand the adjustments whenever there is a fiscal tightening situation, the adjustment largely happens on the capital expenditure part of the government. So the reduction is happening more on the capital expenditure. So that's why one of the reasons why we see there is going to be a sharp decline in the real GDP growth. So in scenario 1, what we try to do is we revert back to the expenditure that has been planned in the budget 2021. That itself shows that the increase in government expenditure would be much more than 9 lakh crore compared to the base case. And I think that's a starting point for us. So we assume in the scenario 1 that government would retain the expenditure plans that they had in the budget 2021. In scenario 2, we expect that the public expenditure would increase by 1% of GDP. Again, this is based on our assumption that the government of India came out with the first stimulus measure of 1.7 lakh crore. And in addition to that, they also proposed to spend on health and other expenditure by 15,000 crores. So overall, we assume that it would be something like 1% of GDP. And in that scenario, we also assume that the reduction in the repo rate, which again came up as a stimulus measure. So in scenario 2, we assume the initial policies intervention by the government of India as well as RBI. In scenario 3, we basically assume that if the expenditure increases by 3% of GDP, and in scenario 4, we assume that what happens if the public expenditure increases by 5% of GDP. Now, this is one of the case where many of the economists have been arguing for increasing the government expenditure by 5%. I'm sure even Dr. Mundle has argued in some of the places where if you want to really overcome the current decline in the economic activity, we should have something like at least 5% of GDP as a stimulus measure. So I'll come to my results. Now, in the base case, these are the policy simulation results for all the scenarios. In the base case, where we imposed a GDP growth of negative growth of minus 12.5%, we're expecting inflation rate of 4.5%, and the fiscal deficit is expected to be at 6.4%. Mind you, actually, in our model, the fiscal deficit is actually a combined deficit of both center and state. So 6.4% is the one which we expect in our base case, and the current account deficit should be around 1.4%. Now, in scenario 1, where we were pushing the public expenditure largely on the capital expenditure side by almost 9 lakh crore, we see a reversal of GDP growth coming down from 12.5% to minus 4.1%. So there is something like almost 8 percentage point increase in the GDP growth because of increasing capital expenditure as per the budget 2021. And in this case, we see that the inflation is rising by almost 2 percentage point, and the fiscal deficit is almost rising by 1 percentage point. Current account deficit again increasing by 1 percentage point. Now in scenario 2, what we have is that, as I said, we assume the 1% increase in government expenditure, as well as increase in the reduction in the reverse repo rate. Now we still see that the GDP growth would end up in a negative territory, that it will be, we are expecting that it will still be at minus 1.9%. Now, when it comes to scenario 3, where we assume that GDP, public expenditure is expected to increase by 3%, and this is where we get a positive growth. I think this is what I want to emphasize, but at the same time, we have seen the inflation picking up to almost 9%, and the fiscal deficit is also going to 8.8%. Now, on the last scenario, which unfortunately, there's a lot of confusion about the government stimulus, announcement of 20 lakh crore, we don't even know what exactly that includes. So there is a confusion about whether additional expenditure, government expenditure is going to be 3% or 5%. A lot of discussion on this, but there is a lot of uncertainty about to what extent the fiscal government is going to increase as part of the stimulus measure. We have seen last 3 days, again, we are not very clear how much is the additional government expenditure is going to be. So maybe we may have to wait for one more day when they come out with the final stimulus package. So assuming this, here we, in the scenario 4, we basically assume a 5% increase in the government expenditure. And this is exactly where we do see that the growth would recover to 3.6%. But unfortunately, the inflation is getting into double digit. And at the same time, we do see that the current account deficit is going to 3.6%. We don't know whether it is, how sustainable is 3.6% at this stage, but this is what our model is saying. But at the same time, I want to also reiterate here, it all depends on what kind of capital, what kind of expenditure government is going to plan. Now, if any increase in the government expenditure is going to only consumption expenditure, that is revenue expenditure, this is what we are going to see. But in our model, we do have an option of looking at if increase in government expenditure goes more towards capital expenditure, then we do see that balance shifting more on the GDP growth side and less on the inflation side. But again, it depends on how government is going to plan the overall stimulus package. So I will stop here. Maybe when question, I'll come back during the question answer session.
Again, I just want to reiterate that given the fact that our QRE was scheduled for release today, and with the recovery package having only been announced 2 days back, there's absolutely no way that, and without obviously a full package being laid out, it's clearly very, very difficult for us to be able to come up with a much more definitive assessment. And one suggestion that we might consider, this is completely impromptu, that the QRE report that we have, which is still, of course, preliminary, could be revised in the next few days as we actually receive more information and details about the composition of both the prior actions that have already been taken, that are incorporated into the 10% of GDP, and the specific nature of the package components in the 10% that was just announced day before or 2 days back. So I guess that clarification may be worthwhile for us to consider. I'll hand it back to Sudipto and then we'll request Usha to come in. Sudipto?
Okay, thank you. Bornali, can you bring up the next slide? Okay, thank you, Shekhar. And again, very welcome to everybody and a very good evening to you. I will now briefly talk about the fiscal outlook and then talk a little bit about the monetary and financial sector situation. In terms of background, as we have seen, there's a great deal of uncertainty certainly about the level of economic activity, but also therefore the knock-on effects on what's happening to revenue, what is going to be happening on the expenditure side. Especially another part of the uncertainty now is the big stimulus that was just announced a couple of days ago, and the details are yet to be fleshed out, and they will certainly have a lot of impact on how government expenditure behaves. And all that would also determine the deficit, fiscal deficit of both the central and state governments and so on. That's the very uncertain situation we are in now. Unlike in earlier presentations when we discussed a lot about the central budget in particular, I think it is worth noting that the budgets that were presented earlier this year, both for the center and the states, are now largely of academic interest in the sense that the revenues are going to be completely different from what were assumed there. and so will the expenditure, and therefore the deficits and so on. Some of us feel that these budgets should now really be completely updated. It's been done before through supplementary budgets, which more accurately reflect the fiscal situation that we have. Now, in this very uncertain situation, we have no option but to think of the outlook in terms of basically our own judgments and assumptions that we can make about how things are working out, both on the real sector as well as on the policy front. Now, what we have done, and that's why Dr. Bhanumurthy just made that presentation, is we've tried to look at the fiscal outlook based on the model-based simulations that he has just discussed. In a sense, it frames our discussion and gives us an opportunity to also take a very preliminary, and I emphasize the word preliminary, look at the big bang 20 trillion rupee stimulus that the Prime Minister announced 3 days ago, emphasizing that this is both in terms of liquidity on the monetary side as well as in terms of expenditure on the government side. Next, please. So, out of the 4 scenarios that Dr. Bhanumurthy just talked about, I will pick 3 of them which are actually relevant to tell the story I want to tell on the fiscal side. Scenario 1 assumes expenditure levels as was there in the central and state government budgets in 2021. That's the budgets that we have had. And in that situation, GDP still declines by 4% because because of the big revenue decline, which then passed on to some extent as a reduction in, or to a large extent, reduction in expenditure. But despite that, there is nevertheless an increase in the fiscal deficit, and that goes up to about 6.6%. I should emphasize that the fiscal deficit I am referring to is not just of the central government, but the central plus state governments. So it is the combined fiscal deficit. But this is also not a true picture deficit. As we all know, there's also the borrowing, off-budget borrowing that is undertaken by public enterprises, both the central and the state government level. So this is not a PSBR. It is just the combined fiscal, or this is not the public sector borrowing requirement. It is just the through the budget fiscal deficit of the central government and of the state governments. The other end of the scenarios that he presented is an assumption of a very high expenditure stimulus of 5% of GDP over and above the budgeted levels for 2021. I must emphasize that we are mainly looking at the fiscal story. Our assumption as far as the monetary side is concerned is the repo reduction and so on, those are factored in. But any part of the stimulus that is now going to feed in to liquidity increases and so on, I'll come to that, but it's not part of this story at the moment. So this large fiscal deficit, this large expenditure stimulus of 5% GDP, that would give us a fairly decent kind of growth, which is probably unimaginable standing where we are right now. However, if that growth were to happen, this would come along with a very large fiscal deficit of 9.4% of GDP. And I emphasize that this is not the PSBR. The PSBR, you would have to add at least a couple of percentage points on that. So that would take you to something like 12% or so. Furthermore, as Bhanumurthy mentioned, this will get us into a high inflation rate, double digit, over 10%, and a current account deficit of 3.6% GDP, which is unsustainable. As you know, we all go by a rule of thumb that something like 2% of GDP is a sustainable level of current account deficit in the Indian context. Now, between these two extreme scenarios, there is a scenario 3, where we assume a smaller expenditure stimulus. By the way, I would mention, as Bhanu said, that I am also one of those who had been pushing for a 5% of GDP expenditure stimulus. I have revised my views after running the simulation and so on. And we are looking at also a smaller expenditure stimulus of 3% of GDP. This is additional spending over and above what was budgeted in the for 2021. And that takes us to a modest but nevertheless positive growth rate, GDP growth rate of about 1.2%. And this comes with a lower inflation compared to scenario 4, about under 9%, a smaller fiscal deficit, and a smaller current account deficit. It is still high at 3%, but closer to what we think is a sustainable level. So among the scenarios we looked at, we would say that this is really our preferred scenario. Next, please, Bornali.
Sudipto, before we leave the slide, may I just request you to clarify that this is 3% of GDP additional spending. The word additional is critical there, because even in the 10% of GDP number that we are discussing, the actual additional expenditure may be much less than that. So this is a complete 3% additional, correct?
Yeah, that's in fact, if you see the first bullet, that's what it says. 3% of GDP additional spending over budgeted levels. So whatever was there in the budget, central and states, on top of that, a 3% of GDP increase. So it's certainly additional.
So it's it's not comparable to the 10% number, for example, that was announced, because that is 10% including.
Yeah.
Okay, sure.
Shekhar, I'm going to discuss that in a later slide.
Sure.
So, I'll clarify this, but it is not. In very brief, that is the case. So, but this is our preferred scenario. Can we go to the next slide, Bornali, please? Okay, and now I come to the really in response to the issue that question that Shekhar was raising. The Prime Minister announced, as you all know, a 20 trillion rupee stimulus package, 10% of GDP. But, and this is the answer to his question, this includes not just expenditure stimulus on the fiscal side, but also a stimulus on the monetary policy side. And in particular, it takes into account already measures done by the RBI in terms of liquidity infusion of about $8 trillion, which works out to, 8 trillion rupees, which works out to about 4% of GDP. I have to say that of the balance that is then left, namely the 12 trillion rupees, for our purposes, we are at the moment taking it as available for additional expenditure. But in fact, it won't be, as I will clarify, because there may be more liquidity infusions on the way. So at the moment, netting out what has already been done in terms of the additional liquidity infusion, the remaining headroom for borrowing to finance COVID-19 related expenditures and so on, out of that 20 trillion envelope, would be as much as 12 trillion rupees. Now, this includes, this 12 trillion that I'm talking about, the headroom, already includes quite a bit of additional spending that has been done over and above the budget so far. In fact, it adds up to about 5.9 trillion rupees, or roughly 3% of GDP. And here I'm only talking about the additional expenditure that has been done at the central level. We do not have details yet of beyond budget expenditure that may have been announced or planned by the state governments. Now, out of this 12 trillion, it is pretty clear that quite a bit of this headroom will in fact be used up for additional liquidity infusion. And in fact, if you reflect on the measures that have been announced in the last 3 days, the first day, the focus was on additional support to small and medium enterprises. Yesterday, the focus was on what support can be provided to the working people, in particular migrant workers who are on the move, through free rations, some announcements about rental accommodation and so on. And today, just before we started, there were announcements about what can be done on the agriculture side to support farmers. A lot of those are actually not additional spending by the government, either center or states, a lot of that is in the nature of enabling arrangements on the monetary side, enabling banks to provide credit at concessional rates and so on, whether it be for MSMEs or for farmers or what have you. So this is, if you will, an assumption which takes all the residual on the fiscal expenditure side, without building in any assumptions about additional liquidity infusion on the monetary side, because we just don't know at this point of time. I'm just making a qualifying remark that it will not be the 12 trillion rupees eventually. Next, please. Bornali. We've lost Bornali. Okay. Next, please. So I will come back to the question of how, if all that borrowing is done, about its financing challenge and so on. But let me spend a little time now. We are making a move from the fiscal story to the monetary story. As you all know, the RBI has been very active in doing everything it can to try and stimulate economic activity, build it up. And so there have been repeated adjustments downwards of the repo rate to help bring down the cost of money to the private sector and so on. There has been some response. I won't say there's been no response, but very weak response. So the weighted average lending rate, the WALR, as you see the green line over there, these are weighted bank group wise and so on. This is all data from the RBI, and there has been very little change. I mean, in April 2018, you were at 9.4%. Today, you're at 9.3%. There's really been no noticeable change. Pretty much the same would apply to the term deposit rates. It's only marginally lower today compared to April 2018. Whereas the repo rate actually has gone down fairly substantially if you take it in relative terms. So weak transmission is the main sort of backstory, underlying story under which we have to look at what can be done further on the monetary policy side. Next, please. Bornali, next, please. Yeah. Now, this is again showing this a different aspect of the weak transmission. There's a difference here in terms of different types of instruments, because if you look at it, the short maturity government bonds actually have very closely tracked the adjustment in the repo rate reductions. But if you look at the long dated 10-year G-Secs, there you find that there's been relatively less response. So there's that, if you will, unevenness in the weakness of the transmission. It remains very weak for long-dated securities, but for short maturity government bonds, there has been significant transmission. Next, please. So that was the cost of money. Now we'll look at the flow of credit, what's been happening. And as you see, this is a very, very depressing curve. It's been going very low throughout the last few quarters of 2019-20. And actually, if you look at more up-to-date data beyond this curve of what's happened in April and so on, it's not that the growth rate has declined. Non-food credit has actually fallen in absolute terms. So we are in a situation where credit has virtually dried up. Next, please. Okay, this gives a more disaggregated picture of what has happened to the flow of credit. And you will see there that it is only in the case of personal loans that we are seeing a substantial growth. It is the fastest growing category of loans. And there, the latest numbers for 28 February show a higher growth than we had a year ago on 15th February 2019. The other sector which has done reasonably well is the services sector, but here also compared to 11% last year, the same time, the credit growth rate is down to under 7%. Agriculture and allied activities is a modest flow of credit and has remained more or less at that level. The really important thing to focus here is on what has happened to micro and small enterprises and medium enterprises, and in particular the industrial sector, including the large enterprises. If you look at that, I mean, actually it is negative growth. That's where the credit has fallen to micro, small enterprises, medium enterprises, all negative. Virtually no growth in lending to large enterprises, and industry also is less than 1% credit growth. The medium industries, interestingly, have done better this year than last year. So that's the uneven picture that you see of credit growth across different segments of borrowers. But the main point is the very sharp squeeze of credit to small and medium enterprises. And this is why, if you recall in the announcements a couple of days ago, this is what the finance minister was focusing on, how to give relief to that group of enterprises. Next, please. Now, what lies behind those rather disturbing graphs that we have just seen? One thing we know is that there's been rising risk aversion against lending to non-bank financial companies. And that happened prior to the COVID-19 crisis that we're in now. It happened, there was a big shock to the system when there were, scams and so forth happening in that non-bank finance, especially the huge ILFS scam and forgeries and so forth. But there have been several others, and that's what accounts for the rising risk aversion of banks to lend to this sector. But this is a big challenge for small, medium enterprises, because NBFCs, the non-bank finance, are indeed a major source of loans to those sectors. Now, here you look at what has happened. There was an attempt to direct more bank credit, what is known as targeted long-term repo operations, this version 2. 25,000 crores was made available for banks to lend, especially to NBFCs and so on, but only half of it was subscribed to. You find similar rising risk aversion regarding lending directly to medium, small enterprises. And this, of course, is likely to rise during this period of the COVID-19 crisis and the lockdown and so on, because everybody knows that the mortality rate among this class of enterprises or establishments is likely to have gone up quite substantially, and their ability to service loans has been considerably diminished. But also I have to say, but that is on the supply side of credit to this group. Even on the demand side, borrowers are now also averse to probably borrowing, because they're not certain that they will be able to service a new debt if they take it on. In fact, those of you who have been listening to what the reactions of people from this category to the announcement that was made 2 or 3 days ago, this is a point we make, that it's welcome, very good, but this is not direct money in our hands. We now have to go and ask for a loan. A bank may or may not approve of it. And I'm not sure, given the very uncertain business outlook, whether I'll be able to service that debt. So the bottom line is that credit flow to medium and small enterprises have virtually dried up. What you need, therefore, is for banks to be given credit guarantees for lending to small, medium enterprises, so they know that at least they are not taking on the risk if there is some default, or similarly, at least partial credit risk guarantees in the case of loans to non-bank finance companies. As it happens, these are precisely the couple of measures that were announced on 13th of May which was focused on support to the small medium enterprises, government credit guarantee for MSMEs, and RBI partial credit guarantee for the non-bank finance companies. Next, please. And now we come to the big question, the sort of elephant in the room. So 20 trillion big bang stimulus package was announced. Now, if you take out of that, the liquidity measures already been taken by the central bank, that still leaves possible 12 trillion stimulus package. Now, this is on top of the already existing borrowing program of the government in the budget, that is before all the coronavirus related measures started. So you are looking at a huge borrowing program of a borrowing asking amount of something like 17 trillion rupees, that works out to close to 10% of GDP, 8 to 10% of GDP. As I said earlier, we don't think that all of this will actually borrowing, but there'll be more being done on the liquidity infusion side out of that 20 trillion envelope. So the 12 trillion will in fact shrink. It will become smaller than what is appearing now. We have to wait for more and more details of how all these schemes that are being announced on a daily basis, of how much of this will be really in terms of liquidity infusion, helping enterprise to borrow from banks, and how much of it will be direct government, additional government expenditure. It seems to me that more rather than less of this is really on the liquidity infusion side. But nevertheless, whatever it is a huge borrowing program that we have. And the big challenge is to ask, how can this all be financed? This kind of scale of financing of government borrowing, sovereign borrowing, center plus states, has really never been undertaken by our financial system. Clearly, what we need to do is no one approach will work. You need to use multiple channels to meet with this. And that brings me to my next slide, please. Yeah, so there are a few possible
we'll
channels.
have to speed up. We want to leave time for Usha, so definitely. And
yeah,
also to answer some questions.
this is my last slide. Very quickly, and this is in fact based on discussions I've had with Usha. There are, one possibility, of course, is additional commercial bank lending, but beyond the point, this will raise yields and crowd out private borrowers. A second innovative suggestion that has been offered is that you actually repurpose and further liberalize the ways and means advances that have been used in the past, increase the period for which such advances can be made up to 1 year, and the cap on this also can be substantially raised, so that this can become a way of, especially the state banks, state governments accessing more assistance from the RBI, and this could be done actually at the repo rate. If none of these are adequate, finally, the residual deficit could be directly monetized by the RBI as a lender of last resort through private placements. My final remark is that while all this is possible, to try and absorb a 20 trillion package, whether it's in terms of liquidity infusion or in terms of additional government spending within 1 year, is asking a lot, and it may actually cause instability in the system. So we would suggest that this 20 trillion be spread out over 2 years, the current financial year and the next financial year, so that you have a more manageable program of borrowing and lending. And this would help us to revive the economy while at the same time maintaining financial stability. And that's my last word. Thank you very much.
Thank you, Sudipto. In order to save time, I'm going to go right ahead and request Usha Thorat to come in with her comments, and then we'll leave some time at the end for answering some of the questions. I see that Dr. Bhanumurthy has already been answering a number of questions directly, but we'll take some questions orally as well. Usha ji.
I guess you can hear me now. My internet may become a little unstable, so I might switch off my video during the course if I find that, you know, my voice is not being heard. Thank you very much for this very, very interesting presentation, and also for the kind of simulations that have been done on with using a macro model. I don't want to get into some of my questions on those. Maybe I can direct those separately offline, but I'll probably just deal with the reason for which I have been invited here on this panel. And thank you very much, Shekhar, for that. The major, actually, the way I had analyzed this 20 trillion, the monetary measures, the direct monetary measures, it was working to about 2.9% of GDP, or about 5.74 trillion. I'm only looking at the various liquidity infusion measures, the CRR reduction, the LTRO, the long-term repo, and the access to the marginal standing facility, those kind of things. And the two packages for credit, which were announced, the MSME one and the other one, they added up to something like 9.1 trillion crores, which works to the first day, it works to about 4.6%. So these two, between the two, take up about, well, 15 lakh crores. So, sorry, 15, yeah, trillion. And the balance that is left is really about 1% of GDP. So I have a balance, as against what Sudipto worked out, I have a balance of about 3.41. 1.6% GDP is the balance that I have not taken into account today's announcements, till yesterday evening, the announcements. So from the market, so there are two things I really thought, because we're talking about financing of the entire package. And rightly, you have said the entire package consists of monetary infusion, credit stimulation, facilitating the credit flow, especially to the micro and small enterprises and agriculture and all the various other sectors, and the direct fiscal cost. So because some of the fiscal expenditure is actually to leveraging the sovereign guarantee to trigger credit flow. For example, if you take the MSME proposal, which says that the government will guarantee 100% of the increase of 20% in the limits to a micro and small enterprise. Visualize a banker, visualize yourself as a banker, lending to a micro and small enterprise, which prior to COVID was working perfectly okay. Now, because of COVID and the last 2 months of lockdown and so on, the enterprise has become, I mean, it's just going down because there are no sales happening, but the expenditure is continuing. So this enterprise really needs, and as you get out of lockdown, and I think that's a very important thing, because if you don't get back into normal transport and manufacturing and other activity, then you need more of credit to be able to holding on operations, because you don't have any sales happening. So one, I'm assuming that the lockout, you get out of lockout, and then this financing is given to a small and medium enterprise, a 20% increase. So the increased lending is 100% guaranteed by the government. I might, as a banker, bite that, because my 100 rupees worth of exposure, which I'm already having to the micro and small enterprise, is already at risk. And that, if I didn't give more money to that enterprise, my entire 100 would be at risk. So this government guarantee that comes in for the additional 20% actually facilitates, I don't have to take on the risk of the additional funding. I'll just manage where my exposure is, and that actually might get the whole thing. So for all the measures, I feel that this measure of the 3 lakh crore of rupees of guarantee will actually work if the banks start looking at those institutions, those small, micro and small enterprises, which were reasonable to start with. So I think in all this, we might mix up a pre-COVID situation and a COVID-induced situation. A pre-COVID situation already saw a lot of units under stress. You already saw the economy slowing down, as you yourself, Bornali's figures were so very clear. It was just consumption expenditure, investment expenditure was going down, credit was also going down. And although a number of measures were taken to ease monetary policy and actually get the banks to start lending, the reasons. One is because of the demand from the private sector itself was not there. And the second is the risk aversion. So really we should look at both the factors, both the demand slowing down and the prospect for growth not that brilliant, as also the fact that banks' balance sheets were stressed. And the NBFCs were also not in that great a shape, many of them. So I think the risk aversion is really what is leading to a further contraction, or rather the credit growth not really picking up and actually coming down. So in that context, I think the measures to bring in credit guarantees, whether partial or 100% of the incremental is also in a way partial. I think these are the ones that we have to see how these really work. And I think the banks will have to then, banks and the NBFCs will really have to utilize these measures to get the credit moving in the system. For simple reason that if they did not start this credit channel, then existing exposure will already also get into risk. So in the pure self-interest, it is necessary. Like I heard the chairman of State Bank of India mentioning on TV yesterday, he says indirectly the government has brought in capital to them because that gives them that leeway to lend. So I think that is one way of financing, because the biggest challenging in this 20 trillion thing is really actually the credit channel and the infusion of liquidity. Because the fiscal package, as I see it so far, is very, very small. What is the challenge of the fiscal package is the additional borrowing, which they announced last Friday, which was that 5 lakh crore additional. So it takes the total borrowing to 12 lakh crore, which included the measures announced in March, which was that 1.75 lakh crore, as also the shortfall in revenue. So the 12 lakh crore, which was a massive increase in the borrowing of the central government. And I'm assuming that shortfall in revenue also definitely factors the shortfall in GST. So I'm assuming that the shortfall in revenue for which the government has to increase its borrowing, some of it will have to obviously go to the states because they will be facing the shortfall on account of the tax revenue decline. So therefore, in this thing, what we have to see is this challenge is really of the 12 lakh crore. Because as I see the additional, maybe 1%, maybe another 2 lakh crore, 14 lakh crore, maybe then is the borrowing program, not including the states. Now, the state borrowing program, when state governments go out for borrowing, they generally face sort of it's more a liquidity spread than really a credit spread. So their borrowing has been at about, depending on the market liquidity conditions, 30 to 40, sometimes 50 to 60 basis points above this.
Usha, we are not able to hear you. You may come back. I hope your internet is still working.
She's been frozen.
Well, that happens when the internet goes down. It's possible. Why don't we proceed to maybe answer a few questions before, while we wait for her internet to stabilize again. Sudipto, you've seen a bunch of questions.
Yes.
Some of them are very interesting. Why don't you pick what you feel you want to answer? Bhanu has been answering them quietly on the side.
A couple
Yes.
of them I noticed which were exactly on the question that we have been addressing, that out of this 20 trillion, how much is supposed to be extra government borrowing and how much of it is really extra liquidity infusion?
Mm-hmm.
And We had just made an assumption that all of it is actually, not that we think so, but we are just waiting for all these, the measures, liquidity type measures to be announced and then take that out. Usha has already done some homework on that, and she was saying that most of the remaining amount is going to be on the liquidity side rather than on the government expenditure side. But even then, the government expenditure already is a very large borrowing program. And as she was saying, when she got frozen, a lot of this does not yet count the states. The states have also lost a lot of revenue especially because of GST and otherwise reduced economic activity. I think Usha is back now. Let me just.
Usha, do you want to continue? We sidewayed into a question, but very relevant to what you were just saying.
Because I was also sort of, I switched into my personal hotspot. So let me just get back to where I left off. So I think it's very critical for the Reserve Bank as debt manager and the government working together to really see that this borrowing program of say 12 lakh crore or 14 lakh crore gross borrowing program is put through without much pressure on yields. The reason for that is that apart from the increase in the cost to the government, I think the yields on government market borrowing are really the benchmark for bank interest rates, lending rates. And lending rates, and it is very essential that there should not be a pressure on lending rates. I don't see the crowding out argument coming really in. In fact, that's why I was wondering where all that inflation is coming from, because the demand is really going to come from additional, to a certain extent, this additional borrowing program which is coming in. And that, I don't see it really crowding out the private demand, because the credit channels, of course, will start having to work. So if the borrowing program is managed with the kind of resources that there are and the kind of instruments that are available to the Reserve Bank and the government, I think this is extremely important that this is managed in a manner that does not put pressure on yields, because yields, putting in pressure on yields is the last thing that we really need for the economy right now. So therefore, what are the options? When you look at the borrowing program, the government has already announced the first half borrowing calendar, which is a combination of 10-year bonds, 15-year bonds, and very long-term bonds, and which are really which meet the requirements of the insurance, the long-term life insurance companies. There would obviously be a huge amount of primary issuances every month, and there is a system of issuing it out into auction in the market, and we use the primary dealers who are actually can underwrite this auction. So maybe a little more incentives to primary dealers to underwrite the auctions, when the devolvement on the Reserve Bank to that extent can be minimized. So the first devolvement then takes place on the primary dealers. So all in all, use the primary dealer system, use the auction route to see what kind of, how the market is able to absorb this additional market borrowing without putting a pressure on yields. And if necessary, one can always intervene in the market and through open market operations, absorb some of that government securities and keep the pressure on yields as stable. I think that there would be a careful use of all instruments, issuing paper into the market, using the primary dealer system, doing open market operations, and then if necessary, and there is no reason why the escape clause in the Fiscal Responsibility Act cannot be utilized to do actually the private placement, which means that primarily government debt is then absorbed by the Reserve Bank of India. And then over some time, RBI sells those securities in the market, because RBI will also have to see how much of reserve money the system really needs and whether it is excessive, whether it's putting difficulties on inflation and what is the money multiplier and so on. So I think those kind of instruments can be used. As far as the WMA is concerned, already the government has, I think the Reserve Bank has increased the WMA limit significantly for the central government. And I would not really recommend WMA as a way to manage the government market borrowing. I think we have got out of the automatic monetization. I think our preference should be to use the auction route and then do open market operations. There is already a huge amount of liquidity which is in the system. No doubt that 8 lakh liquidity which is being put into the repos meant actually for lending. But the lending will happen as the lockdown gets lifted, it will happen. It's at least there to absorb the government yields. And now that the market knows transparently that this kind of market borrowing is coming, then they will also bid accordingly in the auction so that you don't depress the yields too much either, because that becomes a problem. When you take an auction and the interest rates go down too much, subsequent market borrowing, if it's at higher and higher yields, then my portfolio is already under, in the red. So I think it's very important for this to be very finely managed. So my preference is really first for opening it into the auction using the primary dealer system, and then using the open market operations and absorbing the government securities if required in the Reserve Bank's balance sheet. And the WMA should really be used, I would say, as now I find that there has been an increase in the government's Reserve Bank credit to government by a significant amount already in the current financial year. And that is something that will keep going up and down. So I think that is where I would say about the debt management. I think the more critical thing, according to me, is how do we get the banks to, how do we get this whole credit guarantees becoming really effective? There's a lot of detail which is not there available. Sudipto talked about an RBI guarantee. I didn't see any mention of that. It was really a SIDBI guarantee for the credit guarantee of small industries. There's also mention of not exactly a mention of a special purpose vehicle, but there is a mention of 20,000 crores. Perhaps it is through, the institutions through which these guarantees are going to be provided, how they are going to leverage their equity and then borrow maybe from Reserve Bank against the guarantee of government securities on how, or against a government guarantee. How that is to be done, all those details are yet not available.
Thank you, Usha, for that very insightful and also comprehensive rundown of what options Shaktikanta Das and Michael and others face, and the Monetary Policy Committee will also face. So I'm really grateful to you for drilling down into the problems that not just North Block but also Mint Street will have to work. And I think there's an intense coordination that is really required between the two parts of our economic system. Sudipto, we are really almost out of time. Maybe if you just have 2 or 3 questions you want to pick on and either answer yourselves or ask Bornali or Bhanu to answer. We won't take too much time. We're already past 7 o'clock, so maybe just a few minutes more.
Yeah. Let me just address 2. Several people have asked this question about how much of this will all be in terms of extra government borrowing rather than liquidity and so on. We've discussed that at great length. It appears at the moment that of the balance headroom that is there, much of it will be on infusing more liquidity rather than more government borrowing. But we are still waiting for details that need to be fleshed out, and we'll have to wait and see. Usha has talked at great length about the implications of increased liquidity infusion. There was a question, I think Josh asked this question about the impact of all this on the inflationary pressures. Our understanding is that when you pump prime demand, whether through liquidity or through government spending, the demand will probably come back faster than the recovery on the supply side because of the huge disruption of supply chains, and also because of the fact that a lot of the, especially medium small enterprises, there's a high mortality we expect. I mean, the data is not there, but it is quite clear that a lot of them have already disappeared or died. So it will be difficult to very easily bring back the supply response. So demand recovery will run ahead of supply. So, and that I think is the main driver why all are similarly also saying a rise in the inflation rate. Finally, on the thing about the states, Again, something Usha has addressed. A lot of the action on the ground has to be undertaken by the states. They have suffered a great deal because of decline in GST and so on. The FRBM limits really need to be relaxed so that they can do some more borrowing, or the center can give more assistance to them. Let me stop there. We don't have much time. I don't know if Usha or Bhanu or Bornali would like to pick up any questions.
Bornali and then Bhanu, perhaps. Bornali, anything you want to pick up on?
I think there were a couple of questions on political, how is the business confidence index computed? Perception survey of firms across six.
Could we answer since that's in the QRE? I think that can be. It's a methodological issue. If there's anything more topical, then we can go to that, or I'll turn to Bhanu then. Okay, then let me go to Bhanu. Yeah, Bhanu.
Yeah, thank you. Some of the questions I've already answered online, but I just wanted to come back to Madam Thorat when she said about the expenditures not leading to inflation. I think we need to discuss on that model little more later. But I just wanted to tell you, ma'am, actually it all depends on the quality of expenditures. Now, I mean, if the expenditure, most of the expenditure, additional expenditure is actually going towards consumption side, revenue expenditure side, and actually there is no crowding out happening from the private investment side, that actually leads to leakage in the system. That's how you see that even the current account deficit is also widening in this kind of scenario. But if you actually tilt the balance from revenue expenditure to capital expenditure, you would see a slightly different growth as well as current account deficit scenario. And I mean, this is exactly what we have been working for our this FRBM roadmap and all those things.
Usha?
Only one point can I make, Shekhar, on that.
Of course.
I think it's absolutely, and this is something I would have really liked to mention. I think it's absolutely critical that we increase allocation for MNREGA. The kind of, even though that may be completely revenue expenditure demand pushing, I think from a purely employment humanitarian aspect and creating of works in the rural areas where there is a huge return of migrants, it's possible to use this opportunity to really do some wonderful work in the rural areas, including on sustainable management of water. From a long-term perspective, it is possible to work with communities and work through the NREGA program. So I would advocate that in the expenditure pattern, there should be whatever remaining part of the stimulus we are getting. I certainly would really would like the government to go for a big push on the MNREGA. I think that plus some more cash transfers maybe. And one more point which I wanted to mention but I forgot is that for SME, the Reserve Bank would have to, I think about a one-time restructuring. Because just the moratorium may not work. The moratorium was up to May, but if we have to take advantage of this guarantee and see that the credit cycle comes back, then I think a one-time restructuring, not a kind of a restructuring program going into years and years and years, but a reasonable time frame to ensure some sort of a viability of the unit. I think that is done with this guarantee. Then this huge MSME sector, which will start getting back.
Does anybody have any speculation as to why this very obvious work welfare program called MNREGA, which has been with us, we've got so much experience with it, we've got so much data on it, why there has been no mention of it? Is there any explanation for this that I myself have been puzzled by?
There was a mention that wage rate was increased from 180 to 280.
Yeah, but not enough, I would suspect.
No, it's not a question of wage rates. 100 days should be relaxed. There should be additional allocation, and this should be given to the state government for them to do it through this method. The demand, really, the pumping, the fiscal, ideal digging the wells, but digging the wells, we don't have to dig wells. We can do water recharge, we can do watershed management, we can do a lot of that.
Bhanu and will probably end.
Yeah, I think that's a very important point what Madam Thorat has pointed out. if you want to really quickly revive the demand in the rural areas, I think you need to pump in a lot of resources to the rural sector. On the MGNREGS, again, it's a demand-driven program. And I think in one of the press statements, Finance Minister very clearly said, if there's any additional demand for resources, I think the government will be allocating more. I think this is what is happening for the past 5-6 years. So when you come to the supplementary demand for grant, you would see that additional resources provided for the MGNREGS.
Bornali, did you have a last word?
No, I just want to again add to what Madam Thorat and Bhanumurthy said. Yesterday, they did announce that they want to use the Manrega for return migrants to rural areas. So I think the Manrega is a very, very important program. I just want to add is that one more important program is the PDS. I think the extension of that to migrants who don't have ration cards was very, very important announcement yesterday. One of the most significant announcements. And I think there we should consider about universal PDS given the humanitarian crisis.
Okay, we're really at the end of our time for today's webinar and the release of the first quarter 2020 QRE. Let me first take the opportunity to thank all our participants who've been with us patiently for the last hour and a half. Let me also thank Usha Thorat for joining us. This has been very productive, and we must have you more often on our programs. And all of this digital technology now makes it possible, and we don't have to have you on a flight coming here. So we're going to take advantage of this. I want to thank Bornali, Professor Bhanumurthy, Sudipto, and that very large team that you saw on the first slide that have worked very hard. If I were one of the authors, and I think the version that has been put up on the web already says preliminary subject to revision. I think we should probably take some of the very interesting questions we have received, plus the commentary that we have heard here, and maybe go back a little and think about where we may need to perhaps tweak the QRE itself, and possibly issue a slight addendum that caters and takes in the details as they emerge of the stimulus package. I think we owe it to our readers and viewers that we try to catch up with what is happening and be able to maybe look at our assumptions as well as perhaps our conclusions and see how they get shifted as we get more information about what is happening. Again, thank you all for joining us. This is Shekhar Shah from NCER signing off, and we greatly appreciate the opportunity to interact with all of you, and thank you all for your questions. They will be very helpful in thinking about what needs to be done to the QRE draft document that is already on the web. So again, a good night to all. Thank you, and we take leave from you.